All right, hello everybody. Welcome, David Kinder with the Financial Advocacy Podcast. This is a one-off. Um, I was on TikTok just a few moments ago, and we've got a CFP. We talked about last week about the fiduciary duty and all that stuff. We got a CFP on there who's talking about how much life insurance should you have, and he's talking about the often quoted statistic of 7 to 10 times your income. And I'm here to tell you right now that is not a fiduciary standard. I am so tired of seeing these misnomers. And why do they keep persisting? And I think I know why. And the reason I believe that this keeps persisting is because it sounds so reasonable. And it means that it should be an affordable policy and you can get some protection to protect your family. I wish they would wake up. I'm going to show you something that most people have no idea. So I'm going to add this so we can see it. This is an underwriting guide and an underwriting guide by the insurance companies. Okay, so I am not pulling anything out. One company, and since it's right here in the tab, that one company is One America. Now, I'm going to make sure I've got this precise here, is that I am not soliciting anybody to buy a policy at this time. This is not solicitation. This is informational purposes. And I want you to look at this thing. It says personal income replacement. If you're under 40, you could get up to 30 times your earned income. 30 times. Ages 41 to 50, 20 times. 51 to 60, 15 times. 61 to 70, 10 times. 71 plus, 5 times. I want you to think about this. Why would the insurance industry let you take that much risk? Let them take that much risk on one life. And let me share with you exactly why. It is because it's a capital needs analysis. How much money would your family need to get through, essentially through your retirement years? That's why you can get that much. And I believe that as insurance agents, we have a fiduciary responsibility. I call it fiduciary. I know I just badmouthed it all last week. Okay, we have a higher obligation to make sure our clients know how much they can get, and then we can adjust from there. Let me show you another company. I got it right here. This is Penn Mutual. Very similar limits. 18 to 40, 30 times your income. Ages 41 to 45, 25 times. So I have a little bit different breakdown. No problem. 46 to 55, 20 times. 56 to 60, 15. 61 to 70, 10 times. And then when you're over 71, it's an individual consideration. No problem. Why would the industry underwrite so much? And especially if you're looking at term, give you so much benefit for so little premium. Now, of course, we know term does not pay out as much. That's the actuarial reality. But better to have some protection than none, right? That's the key part. And I'm just so tired of these experts saying you should just have 7 to 10 times your income. Why? Why are they limiting it for you? Here's what I believe. A life insurance agent who is professionally trained, who understands the value of the lifetime economic, what was the term? No, I apologize. It's called human economic life value. What is your actual replacement value economically for your family? And that's essentially based on your age and your earning capability. And this is not even including earning increases over time. This is just your current income. So imagine this. You are earning $100,000 a year gross. You're 30. You're probably scheduled to work until age 60, 65, right? That's 30, 35 years. If you had no increases of your income, how much money would be needed to replace your economic value to your family? You would need 30 times your income. Why are these agents that are supposedly acting in your best interest telling you you need less? And I'll tell you why. They want to be seen as reasonable. Let me tell you, we can start off with a higher amount and go lower. It's the same thing, but if you're an agent, you know this with underwriting. You start higher. It's a whole lot easier to go high and then reduce it than to start lower and increase it with underwriters. Why would we do it any differently with what we call field underwriting? The industry needs to be shaken up, and with so much uncertainty out there, it's far better to have some coverage than none. But at the same time, you should be told about the maximum that you can have. And is this about the maximum commission? No, forget the commission. This is about protecting your family. The public needs to know, and I believe they have a fundamental right to know, and insurance agents should be serving their clients by sharing with them exactly how much they can get. Then you adjust for their budget from there. But I'd rather start high and go low. And if you're, well, I don't know. Maybe some people like that political philosophy that was being touted not too long ago. We go, they go high. No, is it? We start low and then we go high. No, 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 no. We start high. When we're talking about protecting families, start high. Show them the maximum possible, then adjust for their budget. Make it simple. And of course, here's the thing. I'm also looking at what are we going to be eventually converting that policy to? Policy conversion is a big deal. I want a convertible policy wherever possible. And it's something that is worth converting to. So when I saw that TikToker, I'm sorry, I am fundamentally against that. And you might be saying, again, why? It's because we need to protect families. And most people vastly underestimate how much life insurance coverage that they have, let alone what they need. But they need a professional agent to show them what they need to have. Let me ask you a different question here. And by the way, Alonzo, salute to you. Glad you're listening. So here's the thing, is that if you were to get car insurance, would you be satisfied with anything less than full replacement value? And you might be saying, maybe, only if I can't afford it. But still, you get your car wrecked or your car stolen, and then what? You get a check. The check has to be able to buy you another car. Life insurance is the only type of insurance that we do not have full replacement value for, and it's normalized. Now, here's what's interesting. I have a credential after my name. It's called CLU, Charter Life Underwriter. It's been around for almost 100 years. And it started by Solomon Huebner. And Solomon Huebner pioneered the concept of human economic life value. What is the replacement value of a human life, economically speaking? And it even factored in other factors of character and and family situation. There's a lot of other things in there, but basically, we just focus on the economic value. So anyway, I want to leave it at that. I know that getting some of you guys watching here, thank you so much for chiming in. It bugs me. The experts are wrong. Find out your human economic life value. How much will your company issue? And then from there, make an informed decision, make it adjust for your budget. And ideally, if you're working with a real professional, they'll help you find the money. They'll help you free up your budget, hopefully without even impacting your lifestyle, to help you to get the coverage you need to protect your families, make sure that they're going to be okay. You don't have to have a major issue should you happen to pass away too soon. This is David Kinder signing off. Thanks so much. I'll see you for our next podcast, which we're scheduled to do it next week. I am not available tomorrow. So we'll do it next week. And I think we're doing it on mortgages. So I'll see you then. Thanks so much.